The Fed just cut interest rates, and we have 12 key money moves to make. So let's first talk about the interest rate cut, and then we'll talk a little bit, and we can kind of maneuver some of these, because this article, this is from Bankrate.com. So it's going to cover a lot of things, because Bankrate does a lot of things. We don't do a lot of these things, but let's talk about what the impact of money will be based on the Fed's rate cut. So as everyone by this point has seen, Jerome Powell and the Fed decided to cut their key interest rate by 50 basis points, which is 0.5%. Yeah. And broadly in the mortgage space, the market was kind of like, yeah, we were expecting that.
Yeah, well, it's been expected already for like months before.
Since like August, right? At the beginning of the month, they were like kind of going down. So the market didn't really have the reaction that I think maybe everyone was expecting it to have. Yeah. But because it already happened.
Yeah. Well, yeah, exactly. It already happened. And there's a lot of other market indicators that come into play that will just influence it, right? For it to not have such a drastic change like we thought we were going to have. Because, I mean, in the beginning, last month, it was about 0.25%. Yeah. And it was like 80-some% felt confident it was going to be 0.25%. And then last 3 weeks, everything just switched. It was more like 50 basis points. And there we have it. And 50 basis points.
I think this has to do with the jobs thing that you and I talked about, and you and I talked about. That 818,000 overstatement of jobs created, I think actually weighed in pretty heavy onto why they ended up going with the 50 basis point. Because I didn't think they were going to do 50. Yeah. Because when again, the projection was if they do a 50 basis point cut, that's an admission that they waited too long, or they need to do a lot right now because they didn't like what they saw.
Correct.
And I think they didn't like what they saw.
That's what I was going to follow up and say as well, that I feel that, it kind of took the market by a slight surprise. I mean, we knew a 25 basis point cut was coming, but I feel like the market was like, wait, do you guys know something that we might not know that's going on? Because it was pretty we saw rates already coming down the last few weeks, and then this last week we actually, went up a little bit higher, which is actually, what I've seen from past data. It's actually very common for whenever they cut rates for them to kind of digress back a little bit, even after they had already been, dropping the last previous weeks.
And I think that sentiment is kind of across the board. I was reading a lot of articles over the weekend and also into the new week talking about just what the impact is. And there's still a lot of people trying to figure out, okay, where's this leave us? Because now the conversation is, well, now they did 50. Yeah. Now they're projecting, or the people in economics and analysts are saying, well, they're probably going to do another 0.25% in November and another 0.25% in December, which means now we're talking about an entire percent change lower in just 4 months.
Yeah.
And that means that maybe all is not well in Fed land, like we've been hoping they were being candid about.
And Jerome Powell was, adamant about saying that, hey, just because we did a 50 basis point doesn't mean we're opening up the door and it's going to be like, hey, next time another 50, because they're still going to stay very data dependent and seeing how the inflation still comes out and other factors that affect rates. But I think that it was a much needed cut, but now we're going to have to see how the rest of the data comes out the next couple of weeks to see if they're going to either cut again, hold off, but then again, the data will let us know.
Yeah. I mean, we already saw it. We've been locking in interest rates and stuff. And right now, I cannot offer to lock a client to what I offered 3 weeks ago. It was much better pricing 3 weeks ago or a month ago versus what it is right now. So whoever we just closed, they just got a better deal.
So let's make a pit stop point right there, because we talk about this all the time, and I know that people watching from the sidelines go, they just say that because they're in sales. And we say you're supposed to be prepared, be proactive, so that when the market conditions are better for you, you can take advantage of it. This is exactly what I'm talking about. Everyone thinks when I say that, I'm putting on the sales hat, and I'm like, I'm just trying to push more mortgages and move more product through escrow. Okay, that can't happen if the deal isn't good and you don't qualify. I'm talking about if you're qualifying, you need to be ready and prepared so that you can do this, what he's talking about. Because now you're looking in the rearview mirror going, rates were better 3 weeks ago than they were right now.
Something I heard that was a very interesting point of view was that historically the best time to buy was a few years ago, but today's probably likely better than tomorrow.
That's like a really broad stroke over the last 100 years.
Yeah.
That's great.
I think a good point of view to look at it right now, if you're looking to be in the market, is if you're going to plan to live in the property for more than 4 years, I don't think timing the market and trying to find the right time to enter the market is going to be the best bet for you. So I think just look for that good deal and then pull the trigger, because chances are that it's going to be a lot more difficult in the months to come. Then it's going to be a lot easier.
It's really hard to peg that right, being
it's
so
such
exact
a tale
and accurate.
Of two stories, because it's like you wait for rates to drop and then inventory to pick up, only to get slashed by more competition that is only going to eat up all that new inventory. So it's kind of like, what do I do? But at the same time, it's, take it from, your future point of view. If you're going to be in the property for the long term, then, focus.
Yeah, exactly.
Down and,
well, the good thing Andy started with we got to prepare it. And going to the first things here, it states get a snapshot of your personal finances, which is good. Yeah, start creating that budget. Now that we see that they cut 50 basis points, well, what does that affect? That's going to affect people's credit card. That's going to affect the adjustable rate mortgage on a HELOC, right? Which is a good thing. Car loan. Some people we've just been putting in a back burner whether they really need that car or not, but now we're starting to see a little bit of breathing room right there. So yeah, start building. It states pretty much start building your budget. How many of you have a budget ready?
Yeah. Comment below if you actually use a personal budget. I actually wrote here in that same section, make a personal profit and loss statement. Yeah. Like what's my income? What's my expenses? I mean, legitimately what they are. And then they're saying here, print out your statements. If you don't actually know, you can look online. That's fine. Yeah. Maybe you don't want to print them out. That's fine. Don't print them out. Take a screenshot of your statements. Write out all the money coming in. Make all the money that is there making interest and see what that is. And then figure out all your debts. List them all out by name, by balance. Put the interest rate there, and at least know what the heck you're looking at. A lot of times people go, "Oh, that statement came in the mail." Throw it in the trash. Okay.
I don't want to see it.
It's on auto pay or whatever. I get it. I understand. I have the convenience of auto pay too for a lot of things.
Oh yeah.
But I still look because I got to know what's going. Gotta go know what's
the
going on.
good thing, my auto pays Tanya.
You have auto pay and she has auto pay.
She's auto pay. I don't even know what it is. But yeah, it stays right there. Just exactly what you said. Then keep track of the income and expenses flowing in and out of your budget each month. So that's what you want to do. Is create that budget.
There's a really good tool that I use, and it's not a paid advertising. It's called Rocket Money, and it actually logs in right into your bank account, and it'll basically track all your expenses, break them down from utilities, recreational, medical, auto, insurance.
Yeah.
Basically, any bill you could kind of set up your own profile, and it's going to track your spending. It's going to let you know how much came in, how much came out, and then you can go over month and compare all your stuff.
Really good.
I know when you saw that.
Huh?
You saw it on TikTok.
No, I saw it on YouTube on an ad.
Or on Instagram. Because I remember
right
seeing
But no,
that.
they're all over the place. Yeah, no,
advertising. It's all over.
Yeah.
Rocket.
And they actually Rocket bought them out because they used to be called something else. And
Got it.
Yeah, but Rocket Money.
No, that's good information.
Yeah.
Get these tools. These are tools that are there accessible to us. Always utilize your resources.
So we're going to continue, but some of these things that we're going to just gloss over because they're not really relevant to exactly what we do. But I want to point out a couple things. The next thing, Memo, is keep chipping away at high interest rate debts.
I like that.
We talk about this all the time. You brought up a situation last week where you're talking about someone who's paying off a lot of personal credit card debt, high interest, and using their refinance to do that, their cash out in order to do that, and saving like $3,000 a month.
Yeah.
Like when he said that, Brian, I was like, what? Wait. You're talking about out of pocket? Their expenses went on $3,000 a month? It's crazy.
It's ridiculous.
Yeah, so, right now it's all about and this is all good information because it just kind of it reiterates what we've been talking about, right? Like it really does. And it's saying prioritize eliminating your high interest rate debt. Yep. When I read this, I was like, wait a minute, you're right. Credit cards are right now like 21, 25% versus before I used to see 8-16%. You know what I mean? And
Long gone.
Hey, your interest charges at the end of the month, they start going up. It used to be a lot less. I'm like, oh, it's not bad. And then now I'm looking at like $80, $100. I'm like, yo, whoa, like, that's just interest.
And then you're just not paying anything off.
No, you're not. I'm literally like,
just treading water. Just barely keep your nose above. So if you can, and you do what this is saying here, you can consolidate some of your outstanding balances as long as you're disciplined in doing so.
Yeah.
If you can get that budget together, get that profit and loss, transfer some of those balances to zero card transfer for the first 12 months, 18 months, something like that. That also will have some sort of commensurate high rate at the end of that term. So know what that is, be disciplined about it. And then the savings, and this is what I wrote down to share with everybody here today. If you can already pay, let's say $200 a month to that card with the high interest rate, and by consolidating it to a zero interest rate transfer, let's say you're paying $150. Take that extra $50 and put it in something that's compounding.
Yeah.
Put it in something like your savings. Put it into another account that might have access to and exposure to the market where it can grow and do some interest. I know I'm only using a small example. But the point is, if you're already used to spending the $200 out of pocket and you can consolidate and spend less to pay off your debt, take that difference and put it in a place where it can grow.
Yeah. No, I love that advice because that's one of the things that I've done. Back in 2010, that's when I learned the whole borrowing from Peter to pay Paul. And that's the reference that I use is, going to the zero introductory rate credit cards, and I would get them for like 18 months with all balance transfers. So I'd pay that, and then I just try to focus on just putting a little more. What I would do is, 18 months. So if I had just for example, $1,000 debt, I divide it over 18 months, and that's what I would pay. So that at the end of the term, it's all pretty much done. At the same time, sometimes we're not in that position to be able to pay that. So what you want to do is just try to pay as much as you can. Your credit will get better. And so therefore by 18 months, you're kind of preparing, not even 18, like 14, you start looking into, I'm not going to pay that thing off. That thing's going to go to like 32%. So I might just do the same thing, rinse and repeat.
Can I ask you something? What is
Please.
something you shouldn't do when you transfer over the balance of the previous card?
Reuse it, recharge it, right? Like try
use
to
it
pay
or
it off.
close it.
Yeah, there you go. Or
Yeah.
close it, because
Leave
if
it
you
open.
close it, your credit's gonna
Correct.
get dinged.
Yeah, one of the things you don't want to do ever is close any credit cards. Allow the creditors to close it, because then that way, when you show that you're getting a lot of debt, what you want to do is just make sure that you don't close it if you're paying it down. And if you already paid it off, don't close it.
Yeah,
Mm-hmm.
yeah.
Yeah, it kills all that credit history that shows on-time payments.
That's what
so
it is, yes.
if you have 36 months of paying on time and you finally pay off that credit card and you're like celebrating being debt-free, that's awesome.
Yeah.
You can cut that card up. You can put it in the shredder. You can toss it in the trash.
don't
You can
close your
leave
account.
it open with the bureaus so that you still have on your credit history credit, I'm saying, that's 36 months of clean payments on time and it's still open. It's going to be open until they close it.
Yeah.
Yeah.
The other thing here, the other cool thing was the next one was watch out for the right time to refinance.
Yes.
I like that
Yeah.
one.
You know what I mean? And so, and it states here pretty much, if you can reduce the fixed mortgage rate by 1/2 to 3/4 of a percentage point, it's time to do the math on how quickly you can recover the closing costs. And there's a method in the math that we do, like VA, you got to recoup the closing costs within 36 months. So if you're looking to sell the house or you're looking to, do something within the next 3 to 5 years, that's a good time to really look at that and see if it's worth the while.
Yeah. And it's
You
a
know?
good strategy too for paying down debt. If you're using your refinance to get your monthly payment lower, using that difference in order to pay down debt, or even put it into some sort of growth fund, that would help as well.
Exactly.
Because again, you're attacking on multiple fronts at the same time, which is kind of the takeaway.
And that's what I think the article is going to go and talk about as well.
Yeah.
Some of those differences.
Yep.
But I like that advice. Just help if the numbers make sense. The cool thing with a lot of these refinances, you'll skip 2 months payments, and then you get what's currently in your escrow account, the property
Get it back.
taxes. You
Recuperate
strategize to get that back. You know what I mean?
Like a mini
And so
cash out.
that could help you pay off some debt, and that's what we practiced the last couple of months.
Yep.
And especially for the higher loan amounts that people have with higher rates that you closed maybe a year and a half ago, even a small change in percentage could be a bigger difference than a lower amount having a higher percentage.
Yeah.
So definitely check the numbers, because you could be saving anywhere between 150 to $300 if you're calculating your numbers right.
Next is just work on boosting your credit score. That's really
So
it's
good.
kind of a plain statement, but we've talked about this on the show separate from this article. We've talked about this. Hey, what do you do when you are on the sidelines and you can't afford to buy?
Yeah.
Work on your credit. Save money as much as you can. Pay down your debt. If you don't have any credit, establish credit.
Yeah, exactly.
So credit is going to be a part of your borrowing life in some form or function.
I'm
so
telling
while
you.
you're unable or not ready, then you could be readying yourself and your financial picture so that when the time does come, you're nice and ready to
Yeah,
go.
I was actually reading this article, and it says rejection rates were highest for individuals with credit scores below 670.
Yeah, 670. Yeah, not
670.
like 620.
No.
Not 670.
Yeah.
And
So
I know
always-
we're seeing our best stuff at 720 or 740 and higher.
Yeah.
Like 670's okay.
Yeah.
But where we're going to see the best for people is 740 and above.
I mean, and then you remember last year when they were putting that rule on the hits, even if you have high credit.
I don't know if our watchers
almost-
now even know what that was, but
Yeah.
that
It was so
that a
silly.
kick
It was
in
like
the
a month
butt.
of like, what the freak?
That was really insulting. Like, oh,
That
you have good
was-
credit. We're going to charge you more to borrow the money.
But that was
'cause you're
only
so
on
disciplined.
conventional.
Yeah.
FHA and VA do not have that rule.
Doesn't matter. I'm still mad about it.
Yeah.
I'm still mad about it. That was
Hey, and then the
terrible.
way they try to play, like, no, well, if you did a credit, other people that don't have good credit, they need a little
It's like
bit of
punishing
help. I'm
people
like,
for
what the
being
heck?
disciplined. You're like, we're gonna
Yeah.
charge you more because you're disciplined. Thanks a lot.
Yeah, so basically it says to improve your credit scores, concentrate on making all debt payments on time and keeping your credit utilization ratio as low as
Yeah.
possible.
Yep.
What that means is don't charge your card that much.
Keep those balances really low.
I know
compared
it's
to
very
the
hard.
limit.
It's easy to say right here, right? Because we're talking about
Sure.
it. But everybody's situation is different. It's different. Some people they're barely making ends meet right now.
Yeah.
Living
That's
paycheck
happening a
to
lot.
paycheck. And I mean, I know I rely on my credit cards a lot, and my goal's always been to pay it off at the end of the month, pay it off. There's been a few months where I haven't been able to do so.
I'll give you a personal analogy. I had a situation not too long ago where I was like, I have to do suspension and tire work on one of my vehicles, and I also am trying to get plane points, flight points, so I can go and see my daughter across the country.
Yeah.
So I'm like, okay, well, I'm going to use my card in this case because I have to pay this $1,100 for all this repair work, but that's also going to earn me this over here, which can pay for my ticket over there.
Yeah.
So I was like, how can I just situate the money so I'm not using my cash right now? I'm still using cash because I got to pay that card off, but it's earning me the points for the flight. So based on the way I was able to like calculate it, it actually worked out.
Yeah, no, it's great. I use my American Express Platinum, everything, you know.
You know what? I use your American Express Platinum too.
Yeah.
What? I use it
It's
too.
like, wait a minute,
And
wait.
here's probably something like our military doesn't know, but for military personnel, they have no annual fee for that card.
Oh, for the Amex?
I didn't know that.
Yeah, they have no annual
wow.
fee for
Sign me
us.
up, I'm
We
going to
do,
the
but
military.
There
they
you go.
don't. And what's cool about that is
Cool.
like you use it for hotels, you use it for.
yeah, you're basically just paying
you
cash.
just fly, and if you're not flying first class, you can go to their lounge anyways. Centurion lounges,
really
which
cool.
they have everywhere. So
That's really nice.
I didn't
Yeah.
know that.
Oh,
you know
yeah.
what? I am going to start using your card now
Oh, there
for
you
real.
go.
I was joking
Okay.
a second ago, but since you told me Tanya puts it on auto pay, I'm just going to start using it.
Tanya is
Centurion.
auto pay.
Hey, Brian, we're going to go to dinner after the show.
Centurion.
Okay.
The next one that I really liked right here was think twice about big ticket purchases. You know,
I put some of that too.
and I like that because I put right here because we go through it right now and things aren't as beautiful as one may seem. We all have our struggles, you know, and I put right here if it's something, is it something you need or want? If it's a want, put that aside, make the sacrifice. Not right now, later, you know. I thought for Tanya and I, just going to one vehicle was going to be really tough. We've been doing it. We've been doing it for the past year and stuff. I think maybe longer than that. So, and it's not like we can't go get another car. We can, but is it a need
Do you need it? Yeah.
or a want? I mean, we work at the same place. We live in the same place.
Yeah.
We go
You
work out
eat
to the same place.
yeah.
You guys are
We go
one.
visit the grandkids
Yeah.
at the same place.
all
Yeah.
together.
Yeah.
So just always think about that, guys. I just say that just in general, women, men, everybody.
Yeah.
I think
You know,
Only
but-
the guys?
Yeah, not just the guys.
especially the guys now.
But yeah, right.
No,
Yeah.
100%. I'm with you 100%. I even wrote down, don't go out financing shit you don't need. Double down and build the war chest.
That's it.
When you said, it isn't all, pretty, everybody's going through a situation, this last, economic downfall, like really taught me a lot about, being able to save, yeah, we make, good amounts of money, but also saving it for a rainy day. This past experience, really opened up my eyes. And now moving forward, when it's like, instead of me saying, hey, I'm going to go and want to buy this, I'm like, how much money can I save and still keep the amount of just spending at the lowest so that I could, actually build my war chest so that next time around, everything's on sale.
Yeah.
Instead of saying like, damn, like now I have to work harder, re up my my savings. But at the same time, I'm like, I did listen that if you made it these last 28 months, you either learned a very expensive lesson or you learned enough to know that, hey, like, we said, last October was the hottest, the rates got the highest, and it's like you touch the stove and you're like, ooh, I don't want to go through that anymore. And I think a lot of people learn that. And if you didn't, like, I hope you don't have to learn it in any other way. But I think a lot of learning experiences and a lot of good learning lessons came out of this last couple of 20. Like,
I mean, and
24 months.
this economy has taken down a lot of companies. I mean, if you look at how many
huge
companies are
ton.
going, so if sometimes I kind of look at it like, man, I'm going through like I look at these companies that were around for
Will.
30, 40 years and they're no longer here. That's to tell you something.
And I like I literally get the goosebumps because that's exactly
Dude,
that.
shut
like,
up, man. You're shaving your arms.
Yeah. Yeah.
Anyways, next subject.
No, make your point. Make your point.
Yeah.
No, I was gonna say it. Like, it's so crazy that you look at yourself like you think it's so bad, but then you look at these bigger companies that are like, yo, they're laying off thousands. They're bankrupt millions, and we're over here like, yo, like
Yeah. Google, Facebook.
Yeah.
But
one of my favorite
exactly.
car
So
brands.
it's-
One of my favorite car brands is just filed bankruptcy recently for $3.2 billion. I think $3.2 billion. It's the Hoonigan brand, which encapsulates all these other car enthusiast off-road type industries. And there's a whole story behind it. I'm not going to get into it, but I think it's like 3.2 billion. And I was like, whoa, that's a lot of money. That's a lot of money.
Like, hey, I can't pay that
Yeah.
anymore.
Yeah,
So
it
don't
was
feel
it was a
bad.
very public filing just
Yeah.
about 2 weeks ago.
Yeah. I mean,
So-
I know in social media portrays everything's perfect.
And
Yeah.
one of the things I will say is just the sooner you could get honest with yourself and just
Perfect.
take
I
responsibility
like that.
and just look at yourself in the mirror. Hey, I made that bad decision. I learned from it. Like, as long as you're cognizant about that, I think moving forward, you'll have a better idea of what to do.
Absolutely.
Yeah.
I'm going to skip past a couple of these guys because I want to move on to the other topics. But if you're interested in learning all the rest of these things listed here in this article, the description will be in the box. You can click in the article and see all these. But essentially, they're talking about keeping up frequent communication with credit card issuers. When the good times are working, or good times for savers will mean more money long term.
Yeah.
Inflation is going down. We're gonna talk about that in a second. And then building your emergency fund. So, and again, these are like kind of mostly like and they're really obvious things, but it's a matter of doing them. I think that's kind of my takeaway is that start being fully 100% aware of your situation financially. Get yourself a budget. Know where your money is coming in. Know where it's going out. Know what it's going to. Know what it's costing you. Know how long it's going to cost you. Know how much you're saving, where you're saving it, and how much you're going to earn on that. And as you can do that and invest over time, you're going to be insulated from market volatility. Yeah. And that is the essence of what the ending of this is. For my side of it is just it takes out the volatility for you when you're fully aware of what's going on. And you're prepared for the unprepared.
Well, I'm going to go with one more, Andy, before we actually skip
to
the other one. I love 11. It says, think about your career and income opportunities. You know, what I liked about that, it's pretty much saying investing yourself. The best, recession-proof situation you could encounter is by investing in yourself, learning a new opportunity. And, I want to use an example like, we've been doing traditional lending for so many years. And the last year and a half, we started learning fix and flip, something that we've had under our noses. DSCR, debt service cover ratio loans. We knew about it. We understood the acronym, but we didn't know how they work. So we invested into that. And now, all of a sudden, we're doing fix and flip, and we're helping other investors become successful at what they're doing. We're helping investors. They thought they were going to fix and flip a property, but we're helping them build their portfolios now because we have the right information and the right products to help them now keep these properties. So I want to share that because that was a pivotal point in our career in 2023 that really helped us kind of carry on through that difficult year. And now
it's just another
we're just investing in ourselves. Now I got a couple of properties, and like I'm telling Tanya a couple of weeks ago, like, can you believe we're under construction building ADUs and she's never even visited once?
And it's because you're
crazy.
Prepared. You're prepared.
Yeah.
You know where your money's at. You know what it's doing, and you're prepared. Like this is the outcome that I'm basically trying to convince people of. Like you're doing the outcome that we keep talking about and encouraging people to do.
And
that's it.
And it's like it's like learning a new language. We completely opened ourselves up to a whole new demographic, a whole new pool of different clientele, and that's the thing that I appreciate a lot about our industry is that there's so many different ways to diversify yourself, so many different ways to find business, and I think that adding this into our tool belt has really just opened up the doors for even more for our future, for our kids' future, and I think that's a beautiful way to invest for your future, for your family, and just for yourself. As long as you have somebody that they're down, like just go ahead and do it because I think in the end you're not gonna fail.
Yeah. How many of our clients are now doing ADUs because of what we're
everybody's
and it's everything that we're trying to do is inspire others. Trust me, if I can do it, I'm telling you, you guys can do it. And I sincerely mean that.
Like we're showing up to the build site in flip flops, shorts, no hard hats. Like thankfully,
wait, hard hats with hard hats.
Yeah,
with hard hats.
Yeah, we do have hard hats. But thankfully there's a great team that takes care of all that, and it allows you not to have to be micromanaging, and that's what a lot of what I think is the most important thing, having the right team to be able to execute it. Yeah.
So this 111, invest in yourself.
Heck yeah.
Make yourself recession proof. Just get into it. Get uncomfortable. And a lot of times it just takes, and you don't have to put endless hours into it. It's just everything takes time. Like they say, one thing you can't buy is knowledge. You have to go through it.
Yeah. Yeah. Some of that you just have to experience. But that personal development part is a great point. Thank you for making that comment as I'm like blasting through it. I'm glad you had that written down.
Yeah.